Welcome to the deep dive. Today, we're jumping straight into Campbell's latest numbers, fiscal 25 results, and their guidance for fiscal 26.
Yeah, we'll unpack the key figures and what they suggest about where this iconic company is heading.
Okay, Campbell's just reported Q4 and full year for fiscal 2025, ending August 3rd. What were the headline numbers? Anything surprising?
What's interesting, for the fourth quarter, reported net sales nudged up 1% to $2.3 billion.
Okay, up 1%.
And this is key. If you look at organic net sales, so stripping out things like acquisitions and an extra week they had, that was actually down 3%.
Ah, right. Organic down.
And profit, adjusted EBIT, that's a key profit measure, dipped 2% to $321 million. And adjusted EPS, earnings per share, also down 2% to 62 cents.
So a bit softer underlying performance in the quarter, despite the headline sales bump. Makes sense. What about the full year, then? That acquisition must have played a bigger role.
It really did. For the full fiscal year, reported net sales saw a healthier 6% increase, hitting $10.3 billion. And yes, that was primarily driven by acquiring Sovos brands, think Rao's pasta sauce.
Right.
But again, organically, core sales were down 1% for the full year. Adjusted EBIT did creep up 2% to $1.5 billion, but adjusted EPS actually fell 4% to $2.97. So you see that pattern top line getting a boost from the acquisition, but profitability is still facing some pressure.
Campbell CEO Mick Beekhausen called the overall 25 results slightly ahead of expectations. How should we read that? Just managing challenge as well.
Yeah, I think that's the right read. Slightly ahead suggests solid execution in what they called a dynamic operating environment. Inflation, supply chain stuff, shifting consumer habits.
Right.
It points more to navigating turbulence effectively rather than, say, blowout growth. He did specifically call out meals and beverages as strong, outpacing the category. Seems the at-home cooking trend is still helping them.
And Rao's, that brand seems to be the star within meals and beverages.
Absolutely. It's a huge win. They highlighted Rao's is getting close to being their $4th billion-dollar brand.
Wow, $1 billion.
Yeah, that's a major milestone. It really validates their strategy of buying these high-growth, more premium brands, shows the integration's working. Even the snack side, despite some category weakness, showed, quote, modest sequential improvement.
Okay, let's dive a bit deeper then. Q4 segment performance. Meals and beverages, you said strong overall, but what about the details? Organic sales were down 3% there.
That's right. Net sales were comparable, but organic dipped 3%. Part of that was lower volume and mix, but also it was partly expected, kind of a normalization.
Normalization? How so?
Well, after they put in a new ERP system that's like the main operating software for Sovos brands in Q3, they had a bit of a shipment pull forward, so Q4 saw the expected dip as things evened out.
Gotcha. But even with that, the Italian sauces sound like they're doing really well, Rao's and Prego.
Oh, definitely. They significantly outpaced the category. Rao's specifically saw high single-digit consumption growth and grabbed another 1.2 points of dollar share.
That's impressive share gain.
It really is. And get this, Rao's and Prego are now number 1 and number 2 in dollar share in Italian sauces. That's a powerful position. Their soups were mostly in line too, broth consumption up 7%. Condensed soups gained share again, 7th quarter in a row.
So pantry staples and premium sauces are holding strong. Okay, let's switch to snacks for Q4. Not quite as smooth sailing there, you mentioned.
A bit more mixed. Net sales were up 2%, but organically they were down 2%. Again, volume and mix declines were the driver, particularly hitting things like Snyder's of Hanover pretzels. But there was sequential improvement from Q3 on that organic sales line. He said better net price realization helped there. So maybe signs of stabilization, perhaps.
And within snacks, they're big leadership brands. Any positive signs?
Performance was mixed, like I said, but improving. 5 of their 8 key brands showed sequential share improvements. That's a positive trend. Pepperidge Farm cookies, for example, grew dollar consumption 3%, thanks partly to that Milano white chocolate innovation.
Right, so innovation helping even if the overall category is a bit soft. Now, that 53rd week in fiscal 25, it landed entirely in Q4. How much did that extra week actually inflate the numbers? How should, listeners think about that?
Yeah, it's a really important point for comparisons. That extra week added an estimated 7% to Q4 net sales. 7%.
Wow.
And about 2% to the full year net sales. So, yeah, it provided a noticeable lift to the reported figures. For you listening, when you see those year-over-year growth rates for Q4 or the full year 25, you've got to mentally discount them a bit to get the true underlying 52-week picture.
Good context. Okay, what about profitability in Q4? How did things like cost inflation, supply chain costs, and you mentioned tariffs, how did that all shake out?
Well, the adjusted gross profit margin decreased by 90 basis points, so almost a full percentage point, down to 30.5% in Q4.
Ouch.
Yeah, mostly driven by cost inflation and other supply chain costs. And significantly, about 30 basis points of that drop was from tariffs, something that's going to be a bigger story in 26. They also spent more on advertising and promotions, which impacted margins too.
Okay. And just quickly, cash flow for the year and shareholder returns. What did that look like?
Pretty solid, actually. Cash flow from operations was $1.13 billion for the year, and they returned a good chunk to shareholders, $521 million total, mostly dividends, $459 million, plus $62 million in share buybacks. They even bumped the dividend up 5% mid-year.
So still generating good cash and rewarding shareholders despite the pressures.
Right. It shows a commitment there.
Okay, that's a good wrap on fiscal 25. Let's pivot now. What's Campbell's forecasting for the year ahead, fiscal 2026? What's the big picture?
Well, they're definitely bracing for headwinds. They talk about a dynamic operating and regulatory environment and substantial input cost pressures.
And the main pressures?
Tariffs. They're explicitly calling that out as the main reason for a reduced earnings outlook for 26. But they do expect to, keep making progress on growth while fighting those cost pressures. It's a balancing act.
Substantial input cost pressures, especially tariffs. Sounds serious. Okay, let's get the hard numbers. What's the guidance for fiscal 26? And this is on that comparable 52-week basis, right?
Correct, comparing apples to apples. So for reported net sales, they expect to be somewhere between down 2% and flat.
Okay.
Organic net sales. They're guiding between down 1% and up 1%. They see meals and beverages staying solid and snacks hopefully stabilizing in the back half of the year.
And the profit outlook.
That's where the impact really shows. Adjusted EBIT is forecast to decline between 13% and 9%.
13 to 9% decline.
Wow.
Yeah.
And adjusted EPS, projected decline of 18% to 12%. That puts the range at about $2.40 to $2.55 per share.
That is a really significant projected drop in earnings, especially EPS. You mentioned tariffs. Just how big of a driver is that?
It's the dominant factor. Get this. Approximately 2/3 of that entire projected year-over-year decline in adjusted EPS for fiscal 26 is down to the estimated net impact of tariffs.
2/3, just from tariffs.
Just from tariffs. Their estimated gross exposure is around 4% of their cost of products sold, their EPS. That's a huge hit.
Okay, so if 2/3 is tariffs, how are they planning to deal with that? What's the mitigation plan?
They're not just taking it on the chin. They have actions planned to offset about 60% of that gross tariff hit in fiscal 26.
60% offset. Okay, how?
Through a bunch of levers. Things like managing inventory strategically, working with suppliers, finding alternative sourcing, driving productivity, cost savings programs, and they also mentioned surgical pricing. So targeted price increases where they think they can make them stick. The goal is to get that net tariff impact down closer to 2% of COPS.
Makes sense. So if tariffs are 2/3 of the EPS pressure, what makes up the other third?
That remaining third comes from what they term base business changes. Primarily, it's increased investment in marketing and selling. They're planning to spend 9 to 10% of net sales there.
So investing more in brands even with the headwinds.
Exactly. It's a strategic choice. Plus, there's some normalization of things like incentive compensation, which might have been lower in 25 and is expected to return to target levels in 26.
Okay, so despite the tariff storm, they are leaning into internal strategies, cost savings, but also investing. Tell us more about those strategic initiatives. What's the plan beyond just managing costs?
Well, a big one is ramping up their cost savings program, PEAK. They've boosted the target significantly by 50%, aiming for $375 million in annualized savings by the end of fiscal 2028, up from $250 million.
And those savings will directly help offset tariffs.
That's the plan. Help offset tariffs and also fund some of those investments they want to make.
And positioning their brands. Are they adapting to what consumers want right now?
They believe their portfolio is generally well positioned for trends like premiumization, flavor exploration, health and wellness, and that ongoing strength in at-home cooking. To really push that, they've launched a new central growth office. The idea is to drive transformative growth across the company. Better consumer insights, marketing, innovation, revenue management.
Yeah.
It sounds like a focused effort to get ahead of the curve.
And innovation. Are we seeing new products making a difference?
Yeah, innovation added about 3% to net sales in fiscal 25, which, for a big company like Campbell's is pretty decent. Examples they gave were avocado oil kettle chips, those Pacific flavored bone broths, and the Milano white chocolate cookies we mentioned.
Right.
And importantly, they're also cleaning up labels. Starting in the second half of fiscal 26, no more FD&C colors in their food and drinks, which aligns with what a lot of consumers are looking for. They're also tweaking how they report share for some snack brands like Cape Cod and Kettle, comparing them to broader categories, which probably gives a clearer picture.
So putting it all together, this deep dive shows Campbell's really navigating a pretty complex environment, doesn't it?
It really does.
Balancing these immediate, pretty harsh pressures like inflation and these big tariffs, while also trying to make these longer-term strategic bets on innovation, cost savings, and adapting to how people eat.
Absolutely. And I think the key question for you, the listener, becomes how well will these strategies actually work? The cost cuts, the new products, the growth office.
Yeah.
How effective will they be against these headwinds like tariffs and maybe cautious consumers, plus whatever the economy throws at them? It's definitely a fascinating case study of a legacy company trying to adapt in real time.